Basically, it's a way of taxing that money that's loaned out or personal assets that are bought in the company's name. Let's say you made $100 million profit. Now, if you were a sole trader, whoops, there's a 4 missing from this tax rate. So option 1 is taxed in your own name at 47% top tax rate. So 47% is the highest marginal tax rate of an individual. Now, that is actually higher if they have a HEX debt. There'll be another 8 to 10%. I can't recall. So you're above half of your profit going to the taxman, and then more again if you don't have private health insurance. So, but let's for argument's sake, let's say 47% tax is option 1, which means on $1 million you're left with $530,000 in after-tax profit. Option 2. If you earn that $1 million profit in a company and you meet the requirements for the reduced company tax rate of 26%, it's a flat rate of tax, so it's not marginal, and you're looking at net after-tax profit of $740,000. So you can see it's a considerable difference, and whether, a way to look at it is whether that $1 million was earned in a single year or over a couple of years. The point is, in a company, you end up with a lot more after-tax money. But the whole idea of Division 7A is for most people, what use is cash in a company? We want to get that out and spend it. And so the 2 examples I've given for years, and I pick on Clive Palmer, but Clive wants to buy a bigger boat. It wasn't him that Division 7A arose, but I use him as an example, bit of an easy target. So he wants to buy a bigger boat. He can buy a bigger one basically with if he funnels the $1 million in profit through a company versus his own name. Funnel's probably a poor choice of words, but you get the idea. Is he's got more net cash if he structures as a company versus taking it out in his own name. So that's example 1. So what he would do in this case is he buys a boat in a company name. Now, that is still a Division 7A issue if the asset he buys is a personal asset. So like a boat, for instance, if it's got nothing to do with his business, then he has Division 7A consequences on his boat, even if it is in the company name. So he doesn't need to even take them. The second option here is where he actually takes the cash out of the company into his own name and buys a house. So he buys another Gold Coast mansion, which he's actually just done to live in. So instead of paying tax on the profit in his own name, the company pays less tax and then it loans him the net profit. So still put it through the company, but instead of paying it out as a salary or a dividend, we loan it out so we don't pay that extra tax. So that's the whole idea. And so why Division 7A was brought in was to stop that. And basically it's a way of taxing that money that's loaned out or personal assets that are bought in the company's name.